Today, the Acala stablecoin regains its value after hackers minted billions of tokens. BitGo threatens to sue Galaxy Digital over its canceled merger. And Claire Ching of Gemini explains what Ethereum investors and businesses can expect from the merge. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Digital assets falling again this morning. By noon Eastern, Bitcoin dropped to $23,000. Ether traded around $1,800 and Cardano dipped to 56 cents. All right, let's talk about today's top stories. First, the Acala stablecoin almost is back on track after hackers torpedoed its value over the weekend. The token has nearly regained its $1 peg after plummeting to as low as 9/10 of a penny on Monday. The recovery is thanks to the protocol destroying the 1.3 billion tokens, which were minted by hackers over the weekend. The token sat around 91 cents by noon Eastern, and Acala said it was working to track down all transactions performed by the wallets linked to the hack. Next, BitGo wants $100 million from Galaxy Digital over its canceled acquisition. In a blog post, the crypto startup responded to Galaxy, ditching the billion-dollar deal, calling it, quote, improper. BitGo said the merger was not set to expire until December 31st of this year, and that Galaxy needs to either pay $100 million or face, quote, damages of that and much more for acting in bad faith. Finally, a new report shows hackers target DeFi protocols. Crypto World's Kate Rooney has all the latest data.
It's not just investors. Crypto criminals are having a tougher time making money in this year's bear market. According to a new report from Chainalysis, the total volume for illicit crypto entities is down 15% from a year ago. That comes as overall crypto volumes have fallen more than 30%. First, the blockchain data firm found a significant drop in scams. It was 65% below the levels through July of last year. And these are typically those get-rich-quick schemes or fake investing opportunities promising enormous returns. Those tend to seem a little less believable with prices down, and fewer people are falling for it. Then there's dark web revenue. That was down 43% from a year ago. It was actually tracking higher for this year until April. That's when Hydra Marketplace, a prominent hub for drug sales, stolen data, and money laundering services, was shut down. The one area of crime still booming, hacks and stolen funds. It topped $1.9 billion so far this year. That's up 58% from a year ago. This is mostly in DeFi, or decentralized finance, and that open source code can make it uniquely vulnerable to hacks. It, on one hand, is used by developers, but is being increasingly exploited by hackers. We've talked about some of those Solana wallets recently getting hacked, and then the Ronin hack was by far the biggest this year. Half of that total has come from North Korean groups, which have taken home about $1 billion in stolen funds. Illicit activity is still less than 1% of crypto's total activity, but these hacks have weighed on investor confidence, and it's been seen as a drag on an industry that's really looking to become more legitimate in the eyes of investors.
Okay, for our main story of the day, we're taking a look at the Ethereum merge. Now, Ether has rallied in recent days as investors anticipate the upgrade, and lots of industry experts claim the transition to proof of stake is a major milestone for Ethereum's adoption. I spoke to Claire Ching, co-head of hedge fund and liquidity solutions at Gemini, about how the merge will change the platform for businesses and investors alike. All right, Claire, so thanks for joining us today. We are here to talk about the Ethereum merge. I want to get into price right away, and then we can expand from there. But how do you think that this transition is going to affect prices?
Yeah, absolutely. I think that, it's always difficult to make price predictions for stuff. But what we do know, though, is that the flow dynamics here are very much changing. So there are two things that are happening. One is that because we're moving from this consensus mechanism change from proof of work to proof of stake, what we're seeing is that there's no longer will be any mining rewards. And so all the miners that are used to getting their mining rewards and therefore have to sell them strategically throughout the market to sort of fund their operations in dollars, that selling pressure goes away entirely in this new paradigm. The second thing is that because of the staking portion of sort of this proof of stake mechanism, investors who've been kind of putting ETH into stake pools effectively are understanding that their ETH will be locked up effectively for the next 6 to 12 months, effectively, when the next Shanghai sort of upgrade will happen in the network post the merge. And so in a lot of ways, you're seeing that. I think we're seeing about 10% of the ETH pool that are being locked up right now. And so again, you're taking away sort of liquidity from the market that could be available to sell. And so those two things in combination are quite powerful. And that's something definitely to watch for. And I think that, we already see that there are a lot of excitement that's generated. I think that this is the biggest narrative that's developing within crypto at the moment. It's certainly decoupling from some of the risk assets that are trading, more macroly. And I think that people are really excited to look for this way to not only have their ETH, but also to kind of hold on to it and generate on a very passive way a 10 to 12% return, which I think is pretty darn good when you look across different asset classes here.
You hit on several things there. Let's start with passive yield. You said about a 10% return. What is sort of the average return for staking Ether currently?
Yeah, so the current ETH staking rewards are around 4 to 5%, and that's fairly consistent across other altcoins in the market as well.
What would you say are some of the benefits of staking, other than the returns? How do you expect that to change after the transition? And even more importantly, what are some of the potential risks that people need to be thinking about?
Yeah, absolutely. I think as an investor, the benefit is quite clear in terms of the passive yield that you gain in this sort of consensus mechanism. And it's a very sustainable way also to generate that yield. It's not something that's going to be fluctuating a ton. And so, as long as you choose sort of your staking providers and input that directly, it's a fairly easy and straightforward process. It's very easy and to access for investors, large or small, in that sense. I think that's a huge benefit. In terms of the another benefit, obviously, is purely on the ESG point in terms of the actual savings on energy, right? Like, because we're no longer using mining computations here, the savings are pretty dramatic. I mean, if you tell me that, hey, we can save 20% by doing something, I would consider that to be pretty wonderful. But in this particular case, you'd be saving 99.95%. I think the downside and the risk that people should always be aware of, right, is that you are earning these yields in ETH terms, which is very similar actually to, I've sat on the traditional investment banking sales and trading floor of foreign exchange for quite a long time. And there, a very popular practice is with these carry trades. So you sell a very low yielding currency like the dollar or the yen, and you thereby go ahead and buy an emerging market currency and to earn the higher interest rate in that emerging market economy. But the issue is that if you're accounting for your returns in dollars or yen, you're going to have this basis difference when you swap that currency back to dollars or yen effectively. And so the same sort of basis risk exists within, ETH and dollars or whatever your base currency would be in that case. And so that's something that people should always be aware of. But again, a very similar parallel and something that a lot of traditional markets and the institutional side are very used to.
All right, we're talking about mining rewards as well. And, on the Bitcoin side, we've talked a lot about miner capitulation over here. So I guess same question today with the drop in rewards for Ethereum miners. How in turn do you see that being felt among investors?
I think the ETH mining and rewards go away altogether. And so you see that a lot of the ETH miners are planning their move to this coin called Ethereum Classic, which is one of the hard forked proof of work Ethereum versions. And so they're kind of moving their equipment and their assets that way to kind of generate, to kind of continue their business. But effectively, in the sort of the new paradigm in terms of the proof of stake ETH, there's really no longer, much need for them altogether.
We saw this morning Coinbase announcing they're pausing ETH and ERC20 deposits and withdrawals as what they're calling a precautionary measure. Shares of Coinbase down 7% on that news initially. What do you make of that?
Yeah, absolutely. I mean, as a traditional investor, I think that, it's always the knee-jerk reaction is always very negative when you see an exchange is shutting down or halting operations. However, I will have to say that I think these are fairly customary. We are, as exchanges are always in the business of protecting our clients' assets. During any hard fork or network upgrades, we are observing the blocks as they're computed and validated properly, and we want to make sure that our clients' assets and their transactions are not, getting caught up in that transition as we make that move. And so, a pause of anywhere from a few hours to a day, I think, is fairly common, and we've certainly done that for other token projects and blockchains as well.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.